Hey, this is Dan Meyer, and today we are going to talk about why the average stock trader fails in the stock market. So we're going to come over here to the diagram here, and this is going to be the natural progression of most people's stock trading. So we're going to notice here that at point A and point J, these are market bottoms, and these are the point of maximum opportunity. These are market lows, so it's a great buying opportunity. But when the market is low, the general public, most people, aren't in a buying type mood. They're feeling depressed, they don't want anything to do with stocks. If you mention the word stock, that's a swear word in their vocabulary. So when the stock market is down, most people don't want anything to do with the stock market. So as the market rises now from point A up to point B, people start feeling a little more optimistic. This is maybe taken a year or two from the market bottom, and things are looking better. So people start to get optimistic about the stock market. As the market rises even more, they start to get excited. The average person starts to feel excitement. Their friends are talking about the market, so they buy some hot stocks. The market continues to rise. Now they are very excited. They think, wow, I am smart. Look at my stocks, they have profits, they're feeling really good. The market continues to rise and they're experiencing euphoria. They think the market's going to go up forever. They're going to make all kinds of money. They already have made money. They think they're the smartest person in the world. But notice this market high, this is when you should be selling. This is when the smart money is selling. But the average person, they're holding. They're excited. Now the market starts to turn, and it starts to bend over, and it's going down. The average person now is starting to feel a little anxious. They're feeling some anxiety, but they're going to hold. It's just a pullback. It comes down a little more. Now they're in denial. They're thinking, no, the market's going to go back. It's going to rally. It's going to go back up. This is just a setback. And they're reassuring themselves that they're in for the long haul. They're an investor and they're going to ride out these dips. But the market doesn't rally. It keeps going down, and now they're experiencing fear, keeps falling, and now they're going to panic. The market continues to fall and they can't take the pain anymore, so they sell their stocks at exactly the wrong point. So what the average trader did in our example here, they bought relatively high and they sold low. That is exactly what you don't want to do. If I was to ask you how do you get rich, what would your answer be? Rockefeller, Mellon, J. Paul Getty, they all told us how. What is it? It's buy low, sell high. But what does the average trader do? They buy high and sell low. So the market continues to fall. Now it's reached the bottom and it starts to go back up again, and basically the average trader just repeats this process. When the market is low and they should be buying, they want nothing to do with the stock market. They got burned and they say, never again, I'm not buying stocks. So they stay out of the market. A couple of years later, things are looking better, and they repeat this process, and they continue to do it until they go broke. So what can you do to avoid this? Well, first, now that you know this is what happens to the average trader, you can look out for it. But the one big thing you can do is set a stop loss order, because nobody knows when this market high is going to be. So if you set a stop loss order, when the market falls below whatever point, it's going to hit your stop loss and automatically take you out of the market, so you can avoid riding the market down. You don't want to be on that roller coaster. And even smarter is to set a trailing stop loss order. So as the market goes up and you're starting to accumulate profits, that your stop loss order keeps on moving up. So it's protecting some of those profits, so when the market does eventually roll over, which it always does, or I never say always, but almost always does, you're out. You're out of the market and you take your profits. And remember, these points, point A and point J, the point of maximum opportunity, when this market is really beat down and is a great buying opportunity, these don't come along very often. There may be once every couple years, maybe once, it might take 5, 6, 7 years before the market gets back to this point. So most of the time when you're buying stocks, you're going to be buying on the upswing. So, which is okay. That's actually can be a very good strategy to do, but you just need to know eventually it's going to turn over and come back down. So you want to have a stop loss order that's going to get you out of the market, so you're not riding the market up and down. You want to buy low, sell when the market gets high, get stopped out and sell, so that way when the market falls, you can buy back in when it's lower. If you bought up here, you rode the market up and then rode it down, and then had to wait for it to come back up, this whole move up right here, you were just making back the money you lost. When if you would have sold up here and then bought back in down here, this would all be profit. That's how you make a lot of money. You want to sell when the market starts to roll over and then buy back in low. That's how you can turn a little money into a lot. So that's why the average trader fails. Now, if you want to see one of my top stock trading strategies, something that is working for me, click on the link right here and enter your email address, and I will email you a training video I did called The Trading Strategy That Can Make You Rich, that will show you what I'm doing to make money in the market right now. So click on the link right here.